Hi guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So if I look or sound tired, it's because I am. I was up pretty late last night, basically watching the new presentation or talk that Monish Pabrai recently did with Peking University over in China. Now, that talk was really interesting, and it was kind of like a continuation of this transition and investment philosophy that Monish Pabrai has been going through over the past maybe 6 months or so. And the main kind of subject of this talk was the idea of spawners, of these businesses that kind of are constantly transforming or expanding their reach into new sort of lines of business, and how that can be really beneficial for shareholders. So throughout the talk, Monish Pabrai talked about sort of the different kind of spawner businesses that he sort of is currently thinking of in his head. He mentioned that he's now got 4 or 5 of these different companies in his portfolio. And he also talked through some of the advantages of owning these spawners, of the growing businesses in terms of trying to find 10 to 100 baggers versus buying the sort of discounted pies and the 50-cent dollars of the world. So in this video, I want to go through my kind of thoughts and quick summary of all the things Monish Pabrai talked about in that video. If you want to see the full presentation from Pabrai, I'll leave a link down in the description below to that. It's about an hour 40 long, but highly recommend checking that out. It was a really good presentation from Monish, and there were also some great questions kind of in relation to some of the things he said from the Peking University students as well. So that will be linked down in the description below, but for now, let's get straight into the summary of this talk from one Mr. Monish Pabrai. So like he has in a couple of recent talks, Monish Pabrai started this one out by talking through, in his mind at least, some of the pros and cons of investing in either a growing pie or a discounted pie, as he sort of calls it. So investing in a growing business where intrinsic value tends to go up over time and you hold them for a long period of time, versus the discounted pies, sort of the 50-cent dollars, perhaps lower quality businesses, but companies that are more easily available to find quite often at a big discount to intrinsic value. Now with the growing pie, these are generally sort of set and forget investments, so they are companies that you tend to buy once and you intend to hold them basically indefinitely, or as Pabrai put it, until you are absolutely certain that they might be in secular decline. Unless you come across that circumstance, you're generally holding these businesses basically forever. And there's a couple of advantages to doing so. So these are the businesses that fall into the camp of being potential 10 to 100 bagger return type stocks. And it's also quite a tax efficient way of investing. So the only time that you're going to pay tax on this, in sort of a US context, of course, it's going to vary a lot depending on what country you're from and what your circumstances are and so on. But in a US context, in a taxable account like Pabrai is running, you're only ever going to have to pay capital gains tax when you sell kind of right at the end of that holding period for this long-term compounder. And if you never sell, then you're never paying capital gains tax and so on. But when you compare that to a discounted pie, a 50-cent dollar, that you're maybe selling within 2 or 3 years of buying it, that tends to be sort of a philosophy where you're paying tax much more often. So that's again something to keep in mind, and something that is a key advantage of buying sort of these growing pies. But Pabrai also talks about putting these things in the context of the overall stock market. So he talks about actually having run the strategy before in sort of the mid to late 90s, and that was a type of market where buying these compounders was really rewarded, kind of like what we've had in the last maybe 5 to 10 years. And he talks about that working really well. And then he talks about from sort of 2000 to say 2008, more of the 50-cent dollar approach working really well. And that was basically just a result of where the market was at. So if you take the 99, 2000 sort of .com boom, you're in a situation where there are a lot of really high flyer, super expensive companies, but mixed in with that were actually some pretty good quality businesses trading at very reasonable prices. The day that the Nasdaq peaked through the .com bubble was the same day that Berkshire hit a multi-year low. So that was a situation where buying potentially slightly lower growth businesses tended to actually work out really, really well. And both of these types of investing can work. It just depends on sort of the context of the overall market that you're in. And Pabrai said basically that it was a mistake for him over the past 5 to 10 years not to switch across to the compounders because the spread was quite tight in terms of how expensive the high growth stocks were versus how cheap the lower quality businesses were. There wasn't a huge amount of difference between them. Yes, the high quality businesses are almost more expensive, but that gap has sort of expanded out now, and he's kind of missed that run over the past several years. So one of the next slides that Manoj Pabrai put up was one that I found super interesting. So this was basically what he calls the path to multibaggers. Now, multibaggers are, of course, the holy grail. Ideally, they're huge multibaggers, which are the 10 to 100x type returns. But basically, all of the multibaggers that he's ever experienced or seen fit into one of these 5 categories. Now, the first category is a focused mousetrap, as Pabrai calls it. These are basically businesses that are intensely focused on basically one line of business or one industry. So he talks through companies like Chipotle Mexican Grill, like McDonald's, like Maotai, the sort of liquor company in China. These are businesses that are intensely focused on one specific segment, whether it's kind of fast casual Mexican food for Chipotle, or whether it's a very specific type of kind of high-end liquor for Maotai, and they do that very well and have built a lot of brand power over time. The second path to multibaggers is to have a great capital allocator at the helm. So Warren Buffett and Berkshire Hathaway are a prime example of that one. They really, if you go back to say the 1960s, did not have a good business. It was a textile company that was basically dying, but nonetheless it became one of the great investments of all time. And that was because you had Buffett at the helm redistributing any money that came in from the textile business into far more profitable opportunities. Next up, you have the Uber cannibals. Now, these are businesses that are basically eating themselves, as the name Uber cannibals suggests, and that essentially means in a stock market context that they are very consistently and very aggressively buying back shares. So in this example, you have a home builder like NVR, or you have AutoZone. These are both businesses that really haven't grown that much over the past decade, but the returns in terms of, for each individual share have been really good. And that's because the share count has gone down substantially because the business is constantly buying back shares. With NVR, the share count's down something like 80% over the last decade or last 20 years, I think it is. I'll try to put the exact numbers up on the screen here. But nonetheless, if you can buy back those shares at attractive prices, again, that's a great way to multi-bagger returns, even without fundamentally growing the business a huge amount. Next up, we have deeply undervalued plays or public LBOs. And the example that Pabrai gives here is with Fiat Chrysler, his investment that he made in around 2012. Basically, the thesis was that Fiat Chrysler was trading at extremely cheap prices. It was trading at a P of 1 based on 2020 earnings. If they could hit those 2020 earnings targets, it was almost certain to be a multi-bagger. Growing companies that hit targets like that don't trade at a P of 1, and that's pretty much exactly what happened with Fiat Chrysler. So that was the fourth type of path to multi-bagger, and the fifth one was spawners, and that was basically the main topic of this talk from Pabrai, and some of the really impressive examples of spawners that he gave were Amazon and Google. So let's get into some more detail with that one. Now, before we get into some of the potential pros and cons of becoming a spawner, as Manoj Pabrai puts it, let's talk about some of the different types of spawning that can happen within business and some of the examples of each of these kind of categories. So the first example that Pabrai gives is adjacent spawning. Now, this is a business that expands its sort of current territory slightly, and the example here he gives is Starbucks. Now, Starbucks are obviously very well known for making coffee at those sort of public locations, but Starbucks has expanded its business into adjacent industries. So they've come out with coffee machines, they've come out with Starbucks alcohol, kind of similar types of categories. They're not going into manufacturing shoes or anything completely different, but they're kind of expanding their reach slightly in order to grow the business. Next up, we have the embryonic spawners. Now, these are businesses that tend to acquire other companies. A really good example here would be something like Facebook. Now, Facebook obviously has its core business, which is the facebook.com platform, which is responsible for a lot of their growth. But in more recent years, they've grown by acquiring other companies. They've bought Instagram for $1 billion. They've bought WhatsApp. and both of those companies have helped massively to expand both the sort of daily and monthly active users across the entire Facebook business, and it's also allowed them to grow substantially their ad revenue income. The next type of spawner we have is the cloner, obviously one that's close to Monish Barai's heart, being a shameless cloner, and the example he gives here is Microsoft. Now, Microsoft are very well known for over time basically either acquiring really good ideas or just cloning them. So we've got a long list of examples here, things like Microsoft Word coming from WordPerfect, PowerPoint, Excel, all being clones or acquisitions of some sort. Basically taking really good features and building their own version of that feature, cloning it, growing it, and again, it's been a really successful way to grow the Microsoft business. And the final two types of spawners, so the first one we have is the non-adjacent spawner. Now this is the example where a company goes into some entirely different industry, and Pabrai talks about BYD here. Now BYD are very well known for making electric cars, but in more recent times they have transitioned into making face masks for obvious reasons. So BYD is very good at making a lot of these small bets on various different sort of lines of business. It means that if one of them fails, or if several of them fails, it's not going to bankrupt the company. But if one of them works, it can create the opportunity for an absolute home run, which is exactly what BYD have done in this situation. And the final holy grail of spawning in business is the Apex spawner. And this is a company that basically does all of the above categories. And the real key ones here would be something like an Amazon. You know, they were originally a bookstore, and now they're almost anything to anyone. And they're doing pretty much all of it really, really well. So that leads Pabrai to talk about his ideal portfolio and what he's really looking for now in a business. And that is to find an Apex spawner at a reasonable price, set it and forget it if he can fill a portfolio with 5 or 10 of these over time, and basically only ever sell them if it's absolutely crystal clear that they are in secular decline. Outside of that, he's making sort of no adjustments to the portfolio. That is nirvana, and that is the ideal situation for Pabrai to be in. So if you have these spawners, often they are extending their runway for growth. He gives the example of Microsoft again. They were originally in a far different business to what they're doing today, where they're working on cloud computing and they're selling subscription software across the entire globe basically at this point. And he gives the example of IBM. Even though IBM has not had a successful run over the recent decade or decades, spawning into new lines of business has really kept that company alive much longer than it would have been alive had it just stuck to its core business several decades ago. Now I want to move on slightly and talk about some numbers that Pabrai gave around market cap and kind of, I guess, fishing in the right ponds, as himself or someone like Charlie Munger might put it. Trying to find these potential 10 to 100 baggers in the stock market. Where do you need to be looking? And this is something that I probably haven't given as much thought as I should have, and some of these numbers, although they might sound really obvious, it's actually quite nice to have these guidelines now in my head. So Pabrai basically brought up the fact that in the last 20 years in the US, there have been around 3,700 IPOs. Now, of those 3,700 IPOs that have happened just purely in the last 20 years, only 9 of those companies are now in the market with greater than a $100 billion market cap. There are much more than 9 companies with a $100 billion market cap, but only about 9 of them have gone public in the last 20 years. So this gives us a few kind of nice rules of thumb. Now, if you want a 10 to 100 bagger, typically you're picking up these companies relatively early in their sort of growth runway. If you're picking them up more than 20 years after they've gone public, it's probably unlikely they're going to be a 10 or 100 bagger. That said, it's not impossible. So if we narrow ourselves down to that universe, and we assume that, you know, if only 9 companies ever get into 100 billion, why don't we just assume that we're never going to own a company ever that gets greater than, say, a $50 billion market cap? That's probably a nice rule of thumb. So that again gives you some guidelines. Now, if you want to get a 10 bagger and you know that, you know, a company that you own is never going to get higher than a $50 billion market cap, that means that you can't buy a company that is ever greater than a $5 billion market cap. So it gives you a nice kind of rough guideline for where to hunt for these particular stocks. And the same thing goes for 100 baggers. Again, if you realize that you're probably never going to own a business which is greater than $50 billion, then that means if you want a 100-bagger, you can only invest in companies that are roughly $500 million or less. Now that of course isn't a hard and fast rule. It's entirely possible that a company trading at $100 billion can become a 10-bagger, or maybe even way out into the future we're going to have $10 trillion companies that are, will go from that point of 100 billion to being 100 baggers. But by and large, if you're fishing in ponds where smaller companies tend to exist, you're probably more likely to find the real potential huge home runs in that section rather than the biggest companies in the world. If Apple, trading at a $2 trillion market cap or something at this point was to be a 10-bagger, it would have to go to 20 trillion. If it was going to be a 100-bagger, it would have to go to 200 trillion, which is just not going to happen anytime soon at least. So that is a bit of a summary from me and some of the things that I learned from Monish Parai's latest talk on multi-baggers and spawners, but there are sort of 2 or 3 just very final things that I want to mention. So the first thing Monish Parai mentioned was his email address. He put up on the screen that his email address is mp@paraifunds.com, and he said, if you've got any ideas of these huge home run multi-baggers or spawners, send them my way. So I'm going to go ahead and take the opportunity to say, if you have any, my email address is investingwithtom@gmail.com. If you send me a multi-bagger or spawner with a nice, well-written thesis and you tell me this thing's worth $1 trillion in 10 years and it's currently trading at 500 million or something, I'm going to be very, very happy with that. And if it works out well, I will send you something as a bit of a gift to say thank you from me to you. So definitely send the multi-baggers and spawners my way. And just the final thing I want to mention is around management. Now, this was a pretty hot topic in terms of the follow-up questions that Parai had, was around finding the right management and the right culture within a business that encourages spawning and so on. So he gave the example of Google. Now, Google, when you read their annual report or see some of their investor presentations, has a very clear segment of their business that they call other bets. Now, in the past, other bets is something that Monish Parai would have attributed 0 value to. Maybe it's going to contain something that is going to work out really, really well, and maybe there is something in there that's going to be a home run, but he didn't want to pay for it. He wanted to be someone that paid an appropriate price for the core business, and if he got this other bet stuff on the side, he kind of treated that like sort of a free lottery ticket, and he didn't really want to pay anything for it. Now that Parai has gone through this transition, he's at a point where he's not going to pay stupid money for it, but he will be willing to pay a slight premium for companies that do have this culture of being able to expand into new lines of business, create new products, and therefore grow the revenue and the earnings of the company. And it's quite a hard rule for him to quantify, but sort of generally speaking and conceptually, he will be willing to pay slightly more for those types of businesses over the types of companies that don't have this sort of spawning culture. And the other thing on management that Parai mentioned quite a lot is that it's important to have the right mindset behind this type of approach in business kind of at the helm. So with these other bets with Google, or with the masks at BYD, or some of the other things that BYD are working on, generally these are small bets which, like I mentioned earlier, if they go wrong, it's not going to kill the company. 90+% of the business is still going to be perfectly fine, even if all of those sort of other initiatives fail. And that's what he really likes. He likes the Jeff Bezoses of the world at the helm, and people that are going to take that approach to spawning and experiment, but they're not going to bet the farm. And he sort of brought up the example of Elon Musk at Tesla. Now, Elon Musk, as brilliant as he is, does not care at all about money, from all anyone can tell. And that kind of makes Parai a little bit uncomfortable. Now, he said Tesla's probably not the greatest example here, but what he's trying to get across is the idea that if you partner with someone that potentially will bet the farm on new bets or other bets, that's probably not a situation that you necessarily want to sort of partner yourself with. It may work out really well, it may work out really poorly, but what he's really hunting for is people that will be willing to sort of behave like the classical entrepreneur that actually takes a lot less risk than it seems like on the surface of things, experiment with small little initiatives but not bet the farm. They wait for some strong evidence on things working out really, really well, and that's when they can grow that line of business moving forward. Okay, so that's my summary of Multibagger's recent presentation to Peking University. Again, link will be down in the description below. I really enjoyed it, and I hope you did too. If you've already watched it and there's anything you got out of it that I haven't mentioned, definitely drop that down in the comments below. I always enjoy those presentations and always pick something up from them. So that's it from me today. One final note, if you do find the spawner, 10-bagger, multi-bagger, send me an email. And I'll be very grateful for that. With all that said, I will see you in the next video. Cheers.